Good evening again. This is Clueless 8, and we're going to cover the infamous US dollar Japanese yen um, spot index, also known in the business as the carry trade. And let me explain to you what's going on here. Very interesting development. Um, Tough to draw a real chart here, but let me just show you what's going on. Notice right here we have a reversal hammer. Of this 50-week moving average, this big, this fat red line. This is very interesting. Okay, this is very interesting. This shows that the bleeding has stopped. Now, the way this particular carry trade works is I've explained to you, and I want you guys to, look it over, Google it, and understand. It's quite simple. When the yen gets cheaper, that means it's rising, because this is a ratio between the US dollar and the yen exchange rate. So once it gets, let's say for example, it jumps from this 101.64 up to 103, that's a pretty tremendous move in the forex markets. That means for every dollar you're buying 103 yen. Right now, for every dollar you're buying at 101.64 yen. Okay, so what it's telling us is that as Japan's version of QE is rolling out with Abenomics, and Japan did have very strong export orders last night. I believe it was 5.1%, well above consensus. Good thing. You're going to see a weaker yen. That means this number is going to go higher. As this number comes down, let's say for example when it came down to towards the 100 level, and the market was fluttering. From 105, it had a 5% type of correction. You had That means that the carry trade was risk off because the yen was getting stronger against the dollar. All right. So as the yen gets stronger against the dollar, that means you're borrowing. It's more expensive to borrow yen and trade in the Globex markets. So that's risk off. Risk on is when the yen is getting cheaper, i.e., this number is going higher, and the yen can be borrowed at very at cheaper prices and be traded around the global markets, and that's known as the carry trade. So here we are. To repeat, we have a reversal hammer. I'm going to there you go. We have a reversal hammer which needs to continue up. I believe we're going to come up and retest the 103 level. Okay, simple retest of the 103 level, and then we go from there. This is not a forex lesson, just trying to explain to you that the markets do move off. The markets do move off this type of correlation, and I watch it as a proxy to the equity markets that we trade in, and it works very well most of the times. All right, so that's it for the Japanese yen. Let's look at the 10-year Treasury yield. Very important again. And let's see what if it gives us any clues of what's going on. At this point, we saw a slight rise in Treasury yields, which means that prices on U.S. Treasuries fell, and money probably flowed back into the equity markets. The correlation is a negative correlation. So basically it simply means that when yields are rising, money is flowing out of the treasury market. That's sort of the textbook thing, into risk assets, which are stocks. When yields are falling, as they were from here, and the market corrected hard, that is that money is going into the treasury market as a safe haven, and money and that is coming out of the equity markets, which is the risk trade. Equities are always known as risk trades. I'm sure you all know that. So saying all that, if we do get up towards this broken 50-week moving average, which is around 2.67, we're still going to be okay. Where the market starts to get nervous, as it did back in January, is when we get towards the 3% yield. That's sort of a threshold of pain for interest rates. And when it gets up there, the interrelated interest rates, which are marked off the 10-year Treasury yield, um, get they spike. So that spikes up mortgage rates, it spikes up lending rates, all kinds of stuff that generally put a brake on the economy. So we are in a sweet spot as long as we are between this 2.5% and 2.7%, around that level. Anything above that crosses the 2.8, markets start to get nervous. So if we look back and see this 2.5 level, we see that it has held very strongly. I've shown this before, back in July of 2013, then again in October of 2013, twice, then once here, the 12th of May. So if we follow this pattern, this holds as a support level, the 2.5%, then this normally corresponds with a strong market rally. Okay, so that's the lesson for today on sort of macroeconomics. Let me see if I can drag something else from here. Maybe show the euro, so you understand a little bit more of macroeconomics that people have asked me to explain. And I'm a terrible teacher. We can see that on a weekly basis, the euro has come down from 1.4. That's 1 euro to 1.4 US dollars, down to this level of 1.36. So at this point, looks like the euro is starting to bottom. And let me see here. It could come as low as 1.34. So again, a stronger euro is not really accommodative to what Mario Draghi and the central bankers in Europe are trying to do. The ECB is trying to go into a mode of a European bailout mechanism. Their version of QE, whether he does it or not, is up in the air, but there is a very strong pressure from the financial markets for him to do something to combat deflation and a slowing European economy, which was speeding up quite well till last quarter, and then it suddenly started to decelerate. So again, to make a long story short, the euro deflated based on the expectations that Mario Draghi was going to cut rates, okay, or do some sort of quantitative easing, which would lower the rates, like we have had in the U.S. So that's it. So nothing major to see here, but we just want to explain a little bit that a stronger euro is bad for European exports, makes their good much more expensive. The BMW and the Mercedes and the Volkswagens of the world get more expensive for us to import and the world to import. So a slightly weaker euro that we're seeing right now, and possibly slightly below, is very conducive to European exports and thereby their economies, which is good for European markets, which have a ripple effect on our markets doing well. Okay, that's enough of the macro stuff. We're going to move on to stocks.